welcome to another episode of The Wealth Defenders with Terry Cox. He's got nearly 20 years of money management experience, and he wants to make that work for you. Every dollar has a job. He's going to put him to work. Bruce Rosenblum here with you as well. Terry, it's great to see you again.
Good to see you as always, Bruce. How's everything?
Just trying to enjoy this crisp fall weather. It's pretty warm out there, right?
Oh, yeah. It's like, what do we do? I'll give you an accurate temperature. It's going to be 88 today. That's some good football weather.
Yeah, that's right. If our viewers don't know, Terry records out of Phoenix, and it's nice and toasty out there. So I don't know. When we think football and fall, we think chilly mornings and everything, but the sun is still shining and the birds are still chirping out there in Phoenix. And
yes, sir.
We want to make sure that stays steady in your money game as well. We want the sun to be shining and the birds to be chirping as well. And that's why today we have 5 questions about asset allocation that can help you adjust your plan to suit your lifestyle. Because as Terry's been talking about, everybody's situation is different.
Yes, sir. Yes. And it all starts with a risk tolerance questionnaire, at least in our
first one,
office.
risk tolerance.
Risk tolerance. Because not everybody has the same capacity for risk as others, and not every security has the same risk level.
Okay.
One of the things that we like to track are 52-week numbers, and we can look at either stocks or mutual funds, and that will give you an idea of, it's not the end-all be-all, but it will give you an idea of what to expect when you buy the security or you make this investment in your portfolio. Some things have large trading ranges, and some things have things that are pretty tight. So it all depends on what you're comfortable with. So that's why we like to start with risk tolerance.
Question number 1 then, what is your risk tolerance? And this makes sense to me because I suppose when you're younger, you can afford to take more risks, but when you're older, things become a bit more serious. You can't really lose money in the end zone.
Right. That's what you want to avoid if you can. So a lot of times they'll have a conversation with a friend or someone, and their friend will say, "Hey, I just bought ABC stock, and it's tripled, and all this kind of stuff." And they come in and they want to, like, "Hey, can I buy this?" So if somebody comes in with something like that, I always ask why. Why would you want to do that? And that kind of leads us into the risk tolerance questionnaires. Mm-hmm. So my office is actually a storefront. So people, if they're walking by and they're curious, they can just open the door and come in. Well, I had a guy that came in one time, and he wanted to say hello. So I gave him, I chatted with him for a few minutes. But the first question he asked me was, "So what do you have?" And I said, "Well, I have a lot of things. What exactly are you looking for?" Yeah. And he said, "Well, I want to buy a stock." I'm like, "Okay, you got to give me a little more." So we had I had to kind of pull some information out of him. But sometimes I think people feel obligated. They'll think, "Okay, I'm suddenly in the middle of my life, and I really haven't done any retirement planning."
Right.
My friends they're buying stocks. Maybe I should buy stocks. And that's why we always like to start with that risk tolerance. And prior to that, it's always a conversation about what you're looking to accomplish in the first place, because not everybody is looking to accomplish the same thing.
Of course. And this seems like a pretty big misconception because, Terry, you're not a stockbroker. You're not a banker.
That's right. We like to focus more on the plan. Number one, identifying what your goals are, what your dreams are, and then start plugging you into, they don't have to be investments. They can be, different insurance products in some cases, but things that are going to help you meet the needs that you want met.
So then, is that the biggest difference between a stockbroker and then what you do?
Yes. So one of the tools, and I've talked about this on a couple of our episodes previous, but we use a tool called the asset map. We like to capture our clients' assets, whether it's their home, their Roth IRA, their 401k plan, their insurance, their long-term care. And basically it comes down to, it's a one-page spreadsheet. Because if we can identify what you already have and block it in on one piece of paper and know where you're at, then that's a great jumping off point for me to start doing my job for you and plugging in the holes or filling in the gaps that may be there.
I see. So you're designing the blueprint for people that people can use to build that retirement. It's not just selling people something or getting people plugged into the market. This is more serious. This is giving people the framework that they can have to be successful here.
That's right. That's right. Because once you know where all of your assets are and where you're at in your life and what you're looking to accomplish, that's when we can start plugging things in. Okay, do we need some more dividend paying stocks? Do we need a growth element? Do we need, maybe an income element? So we can build all of that out. But it all starts from having that initial conversation and knowing where you're at and where you want to go.
Okay, so you're talking with people about their risk tolerance. That's how you get some ideas about their best chance for asset allocation. You're talking about risk capacity as well. What are some other things that you're trying to cover here when you're figuring out what's the path forward for people?
I try to take percentages and put them into dollars, because sometimes percentages can sound kind of benign, right? When you start talking with people, they're like, yeah, I could, if my portfolio dropped 15 or 20%, that'd be okay. Like, okay, well, let's put a number to that. And then, depending on the size of the portfolio, depends on what size that 15 or 20% is. And sometimes that's the eye opener. And people then say, well, okay, maybe I don't have the risk capacity that I thought I did. Let's talk about something else. But yeah, going back to that risk score, when that score is completed, now it's going to give you, it looks like a little speed limit sign when it's done. And that's kind of how fast you're driving down the path to retirement. But then we want to go the next step and say, okay, now let's start talking about percentages, dollars, and what that actually looks like in your portfolio. Sometimes people are ready to, amp it up a little bit, but in most cases, they want to reevaluate and bring it down a little bit.
It sounds like this really gets rid of that fog of war, because a lot of times you invest and you're not sure where it's going to go, but you're helping people see a bit further down the line here.
Yes, because and we talked a bit about this earlier. When we're looking at the price, the share price of a stock or a mutual fund. If you can look back over like the last year or the last 3 years, 5 years to see what it's done, number one, you know where you're buying in at. If you're buying in somewhere in the middle or at the top or at the bottom. So at least that gives you an idea of what to expect. So if you look at like Tesla, for example, over the last year, it's been as low as like $140 a share and as high as like 300. So that depending on where you bought that at. I mean, those are huge swings back and forth. So if you can, and there might be a place for that in your portfolio, but if you look at, some blue chip, dividend paying stock, it might have a trading range of maybe, $20 or $30 over the course of the last year. So by comparing those numbers gives you, like you said, that piece of going, okay, I know where I'm buying this at. I know what to expect. I'm good.
And this makes me think of, talking about stock fluctuations, it makes me think of all the people trying to put calls and puts on Tesla stock and other blue chip stocks, which is, it's essentially gambling. You're really gambling with things. That's short-term gain. A lot of risk there. And it makes me wonder, you talk about time horizons too when you're playing with clients.
Oh, absolutely. Yep. And that plays in, that's a big factor that plays into the overall plan, because, depending on where you're at, if you're 25, you can deal with whatever. But if you're 55 or 60, maybe not. So that's why those conversations always have to take place before we ever start making any kind of investments for the clients.
Got it. Okay. So these questions we're asking here, number one, what's your risk tolerance? Number two, what's your risk capacity? And number three, what's your time horizon? These are all important questions to ask. What else do you ask to kind of paint the picture for folks?
Well, we want to know, first of all, do they have kids, grandkids? Do they plan on leaving a legacy? if they're stepping into retirement, is your house paid for? Are you still carrying a mortgage? What do your car payments look like? Because now that all comes back to budget. Because if you've got, let's say you're one of these people that have your house paid for, your car paid for, and you're walking into retirement with no debt other than like your monthly utilities or whatever.
Yeah.
Hey, you're golden. I mean, and what you're going to need on a month to month basis is a lot smaller than somebody who's just the opposite. Maybe they're carrying a car note or a house note, or they're going to be carrying one for a few years. Sometimes that's the plan. It's like I got as close as I could, but I'm going to be, making a house payment for another 4 or 5 years. So yeah, so it all comes down to that budget, your needs, time horizon, risk capacity, because not everything is going to act the same way in all markets. So you want to make sure that what you have is going to be acting in a way that you're comfortable with.
But of course, we got to ask the question: what about the returns? What kind of returns do people want? That's what it all boils down to, right? How much money can you get back here?
Absolutely. So one of the things that we default to on our asset map program, when we're laying out the plan for the first time, I run all of our returns at like a 6% return, because I want to say
6%.
If we're gonna let's run this at a conservative number to see if we can get there. If we can, fantastic. That's awesome. But if we need to add some risk, maybe the return has to be 7, 8, 9, whatever the case may be. Now we can then start looking at other assets to plug in that could help meet that number. Yeah, but if we can get you locked in at a lower number on the rate of return, that's all the better, because if anything bigger comes in on the return side, it just makes retirement that much more enjoyable.
Right. I was looking at a scenario a couple of days ago. This person was expecting 30% dividends on certain stock transactions. And I thought to myself, man, that's a little optimistic, isn't it?
Man, if I could give you 30%, I would give you the only game in town.
Right. I mean, you're beating the market hands down. You're better than Warren Buffett in that case.
Exactly.
But would you say that 6% then that's reasonable then? That's what people should be thinking about, and not these astronomical numbers?
Well, that's where I like to start, because if you take a look at the S&P 500 and you go back and pick any 10-year time frame that you want to pick, and historically you're going to get somewhere between 8 and 10% out of the S&P. So if we can err on the side of caution and get you where you need to be, that's a good place. That's where I like to jump off at. And then if we need to add, because I'd rather start at a lower number than a higher number to make sure that, because like I said, if you get excess returns above that, you're gonna have a happier retirement.
That's it, the cherry on top of that sundae.
Cherry.
Absolutely. Yeah. So talking about these 5 questions, we've done 4 of them. We got time for one more here. We got, what is your risk tolerance? What's your risk capacity? What's your time horizon? What kind of returns do you need? And the last one, what are your legacy goals?
Yes, absolutely. So some people, they want to leave money to kids, grandkids, charities, things of that nature. Sometimes, depending on how the portfolio performs, and maybe they got to retirement with not the amount that they really wanted to, but they still want to leave some money. That's where you can plug in some life insurance plans that carry a death benefit, that you can buy this death benefit to pass on to your kids or your charities or whatever. But again, all of these conversations will lead us to the legacy wants of each individual. Yeah.
And I know you have some of your clients, they plan to leave a lot to their kids. Some clients plan to leave a little to their kids. And there are people out there, they're thinking about what they should do in either circumstance, and they've got questions. They can get a hold of you to get those answers, can't they?
Yeah, absolutely. They can give us a call. They can visit our website, www.tdc.financial. Every week, we leave some appointments available for our listeners that want to come in and have that initial conversation. Those are all complimentary, by the way. So no obligation, no cost. But the reason we do that is because I think it's so important to have that initial conversation. And find out where you're at and where you want to be. And, let's not put any pressure on you. Let's just have a comfortable conversation and see where you're at.
Well, for our viewers, if you want to find out where you're at and then where you want to be, give Terry a call. Information is going to be on the screen. Make sure you like, comment, and subscribe to the podcast as well. We talk about this stuff every week. It's a fantastic show, dropping key knowledge so you can get your money working the way it needs to be working so you can have the retirement of your dreams. Anything you want to add, Terry?
It's been a pleasure, Bruce. I love having these conversations. I hope I hope the listeners are enjoying these conversations as well. Hopefully, it makes something that at least resonates and wants to give a call and have a conversation.
Feel the same way. Looking forward to that next one. From the Wealth Defenders, we're signing off. We will see you next time.
Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as complete analysis of subjects discussed. Discussions and answers to questions do not involve the rendering of personalized investment advice, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented. Encompass More Asset Management is registered as an investment advisor with the SEC and only transacts business in states where it is properly registered or is excluded or exempted from registration requirements. Registration with the SEC does not imply a certain level of skill or training.